SCHD versus DGRO in 2025, two of the most powerful dividend ETFs in the market. But which one actually delivers better long-term income and growth for investors like you? Let's break it down. Welcome back to Asset Index, where we help you navigate wealth with data, not hype. In this episode, we're comparing SCHD and DGRO, two dividend-focused ETFs that seem similar on the surface, but perform quite differently over time. Whether you're trying to build passive income, protect your portfolio from volatility, or maximize total return, this comparison will help you make an informed decision. Let's start with the basics. What is SCHD? SCHD is the Schwab US Dividend Equity ETF. It focuses on high-quality US companies with a consistent history of paying and growing dividends. Think companies like Pepsi, Coca-Cola, Verizon, Merck, and Texas Instruments. SCHD tracks the Dow Jones US Dividend 100 Index. To qualify, a stock must have at least 10 consecutive years of dividend payments, solid fundamentals, and high return on equity. It's known for quality filtering and reliability. Now, what about DGRO? DGRO is the iShares Core Dividend Growth ETF by BlackRock. It tracks the Morningstar US Dividend Growth Index. This fund focuses on companies with consistent dividend growth, not just high yield. It includes names like Microsoft, Apple, JP Morgan Chase, and United Health. The key difference: DGRO leans more toward companies that are growing their dividends steadily, while SCHD leans more toward yield and quality balance sheets. Let's talk about yield. As of mid-2025, SCHD is yielding around 3.5% to 4%. Meanwhile, DGRO yields closer to 2.3% to 2.6%. That's a big difference if you're focused on monthly or quarterly income. For example, on a $100,000 investment, SCHD would produce around $3,500 to $4,000 annually. DGRO would produce closer to $2,300 to $2,600. But yield isn't the full story. Let's move to total return. Over the past 5 years, SCHD has returned an average of about 10% annually. DGRO, closer to 11%. DGRO has a slight edge in total return, largely due to its exposure to higher growth stocks like tech and healthcare. So which is better? It depends on what you're solving for. If your priority is monthly or quarterly income, SCHD gives you more upfront. But if you're focused on dividend growth and price appreciation, DGRO could have the edge. Let's now look at diversification and sector exposure. SCHD is heavily weighted in industrials, consumer staples, and financials. DGRO, by contrast, holds more tech and healthcare. This gives DGRO more modern growth tilt, while SCHD leans into defensive sectors with more consistent payouts. What about risk and volatility? SCHD is known for its stability. It tends to perform better during market downturns because of its defensive sector mix and focus on profitability. DGRO can be more sensitive to broader market moves, especially because it includes high-growth tech names that are more volatile during economic uncertainty. So if you're someone who values stability in your income stream, SCHD might feel more comfortable. Let's now compare fees. SCHD 0.06% expense ratio. DGRO 0.08% expense ratio. So they're both extremely low cost. On a $10,000 investment, you're paying $6 annually for SCHD and $8 for DGRO. A negligible difference. Next, let's look at dividend growth. DGRO has grown its dividend more consistently year over year. That makes it attractive for long-term income scaling. SCHD's dividend is higher today, but growth is slower. So if your strategy is to live off dividends now, SCHD is more appealing. If your plan is to accumulate shares and grow income over time, DGRO deserves a look. Let's summarize. Pick SCHD if you want. Higher current yield, stability during downturns, defensive sector exposure, simpler income now. Pick DGRO if you want. Long-term dividend growth. Slightly higher total return potential, exposure to tech and healthcare, income scaling over time. Or, do what many investors do, own both. SCHD for income stability, DGRO for growth and scalability. Together, they can create a powerful dividend income strategy with both yield and long-term upside. What are you prioritizing in your portfolio right now? Let us know in the comments below. And if you're serious about building long-term wealth through dividend ETFs like SCHD and DGRO, subscribe to Asset Index for more weekly breakdowns and data-backed investing strategies. See you in the next one.